I think they're comforted. I don't think it's a big shocker to them. The market here seems to be a little bit muted, almost like it was consensus. I don't think it's going to do anything but overstate the obvious that the Fed's going to have to raise rates, and it's going to be happening very, very soon.
Do you think it signals that the economy is strong enough to withstand higher interest rates?
Yeah, I do think it's strong enough. I think the problem is that we haven't raised rates in 9 years. We have a big, big balance sheet, $2.6 trillion in excess reserves. It's going to just have to be like micromanaged. It's going to be different than anything we've ever seen before. And I think because of that, it's going to be very data dependent. The market seems to be has overreacted to what the Fed's going to do. But the short answer is absolutely the market can handle a symbolic rate hike.
Larry, the market obviously clearly focused now on the timing and the pace of those rate hikes post a potential move in December. We have spoken to you previously, and we do know that your base case has remained December. What about beyond that, though, going into next year? What are your forecasts in terms of what we'll see the Fed doing?
Yeah, this is really fun. I mean, I think that they're going to raise rates 3 times in 2016. And my premise for this is I think inflation is higher than most of us think it is, or at least consensus or whatever they tell us. Even the fact that we see stability in oil prices, and I do see oil prices going higher mid next year, going into the 3rd and 4th quarter. All that to say, I think inflation is going to come up a little bit faster than we expect. Therefore, we're going to see 3 rate hikes next year.
Just you mentioned those oil prices there and your expectations with them going higher. What's that based around? I mean, is that based around the supply and demand dynamic, I guess, stabilizing somewhat?
Yeah, I think it's more of a supply picture than anything else. I mean, as long as demand stays the way it is, even if it's a little bit softer than it was in 2015, the fact that we're running off our supply, and we have an enormous glut still, but it's running off, I can see that by the middle of 2016 starting to evaporate quite quickly, and all of a sudden we'll see Brent up around, I could see it up around $70 a barrel this time next year.
Hi Larry, it's Tim Rocks here, also in the studio. I was wondering your take on wages growth. Clearly that will be very important to the pace of Fed tightening through 2016 and beyond. There's a lot of sort of mixed messages, mixed views about the extent to which wages growth is taking off. What's your take?
Yeah, it's a confusing take and a great line of questioning, because I do feel like there is wage inflation going on here. Even though in the United States our participation rate is at all-time lows, and also combine the fact that the productivity is nil. So I'm not sure why it is, but it does seem to be present, and I think that's going to add to the inflation picture straight away, and more to my case of them having to be a little bit more proactive about raising rates. I mean, I don't know too many people who've gotten an increase in pay, but it does seem that there is wage inflation in different pockets, and not just the lower-end jobs that most people think. If you look at the Bureau of Labor Statistics, you'll see it's pretty much across the board that there has been a slight increase in wages.
We speak there about this potential move in December, although we also have been speaking a lot about divergence recently. Larry, do you think that monetary policy is set for clear divergence in December, with obviously the US potentially tightening rates, but on the flip side, the ECB easing?
Yeah, I think it's going to happen, and we're going to see it next month. But I think it's deeply built into the rate scenario right now, and also the FX markets. But yeah, I do think Draghi has a big toolbox at his disposal, and their growth momentum has stalled, as we've seen, especially on the export side of things. So they're a few years behind the U.S. in regards to monetary policy, and so he's going to have to do something, and I do believe he's going to act. But I don't think that's going to be a big shocker to the market, because it seems like everybody is saying the same thing. I think the bigger shocker would be if RBA next week does in fact cut rates. That seems to be more of a shocker.
Interesting. It does seem like growth in some of those advanced economies is being offset by weakness in commodity markets and those emerging economies as well. Larry, if the Fed does hike in December, do you think that will only accentuate the divide?
I do. I think it's going to accentuate it in a big way. But I think, on the other hand, it's going to come at the expense of bondholders. It's not going to be as much as the banks or the governments being on the hook like they were back in the 1990s. I mean, I think the bank situation is a lot healthier than it was back in the mid-1990s. And I think that's, everybody is drawing that parallel, and I think it's incorrect. It's definitely going to be a rich versus poor economy for a while, although I do seem to think that there's going to be continued stabilization in some of the emerging market countries, precisely because the banks do have their houses in order relative to the way they did before.